the way I like to think about it is there are two main drivers, and they can go up or down, and the markets reflect those things. So if you think about what are they? Inflation and growth. And if and then inflation can rise or fall, and growth can rise and fall. And if you can have a balanced portfolio of those, like 25% of your risk in each one of the portfolios that would do well if that happened, you have a balanced portfolio, then you're going to have an element of diversification so that you're not exposed to too much one scenario.
Bitcoin has reached $30,000, a milestone it has not achieved since June of 2022, and is receiving significant attention due to an 80% increase year-to-date. This is a stark contrast to the NASDAQ 100, which has seen a strong showing with a 20% increase but falls far behind Bitcoin. Despite this, billionaire legendary investor Ray Dalio has changed his stance on Bitcoin. Previously, in 2017, Dalio called Bitcoin a bubble, but in 2021, he stated that he owned some and believed it had merit as a small portion of a diversified portfolio, referring to it as an alternative to gold for younger generations.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
Bitcoin is neither an effective storehold of wealth or a medium of exchange. So it's not an effective currency. It has a volatility to it that has no relation to practically anything. The owners of it, it goes down because, let's say, if people in the tech business like it, and then there's a tech problem, then they sell it to raise things and so on and so forth. So it has, it's not an effective. It's a very, very poor alternative to gold. Okay, we can get into why that is. Central banks, by the way, own gold, and it's their third largest reserve. And U.S. dollars, euros, gold, and then yen, and it's got the history of it. And one can say it's not digital, and I don't know, but I would, So we're not, and they can outlaw it, they can regulate it. Central banks and countries pretty much don't want it anyway. So it's not a good viable alternative. If one wants to say, maybe all that's wrong and doesn't matter and so on. And like I said, you have to assume, like I said then, that it goes down 80%. You can have it go down 80%. And if you want to have a little bit on it, you can have it. It's not a big asset. It gets an amount of attention, which is way out of proportion to its size. It's, I don't know, like 25% of the size of Microsoft. And that's one stock in a world that has a lot of assets and stock markets in it. So that's what I think. Again, I would emphasize that the three things I look at most is how's the finances? Is the country, just like a company or an individual, are they earning more than they're spending? So they have a good income statement. Do they have a good balance sheet? Second, do they have internal order or disorder? And third, are they going to have a conflict? I'm not saying get out of the United States, and I'm not saying get totally out of China. Okay, I think that as a general rule, I want to have my risk broken up into 10 to 15 uncorrelated good assets. And so that means I don't want to have more than 10%, ideally not more than 7.5%. In any one of those good assets, and if I'm judging goodness, I'm judging it by what's their income statement, finances like? Are they having internal conflict, and are they in the midst of being in a war? I want to stay away generally for those, but I still want some of those portfolios in that. So that's good diversification for me. Dollars are debt. In other words, when one holds a dollar, a central bank, they hold a debt asset. And generally speaking, the world is holding a lot of US dollar denominated debt. So the holders of that would say, I'm already overexposed to US dollar denominated debt. And so there's less of a eagerness to buy the debt. And that eagerness to buy the debt is also reduced by, two main things. One is the United States share of world trade has gone down and China's has gone up. And so you save really for using spending internationally for that reason. And then also sanctions have increased the perceived risk that those debt assets can be frozen in the way that they've been frozen for Russia. So around the world, different countries increasingly have that risk. So for those reasons, there's less desire to hold US dollar denominated debt, which means less US dollars. So the supply demand picture is worsening, particularly as we continue to have to sell them internationally to fund the deficit. And once you've got that portfolio established, so you can think, how many weeks, months, years can I live if, on that? And so you have your safety bulletproof portfolio that, but it can't be in cash. Like people think, cash is the least risk investment because I hold it and it doesn't go up and down, and I receive my interest rate. Well, it depends on the interest rate that you have in relation to the inflation rate, because otherwise you can have a bad result because of inflation. So you have to think about it in real buying power, and you have to have it as a diversified portfolio. So those are the things that I would emphasize to do, and to have it also diversified internationally.
To view the complete interview, please see the link provided in the description. What are your thoughts on Dalio's views? Do you believe they are accurate? Share your thoughts in the comments section below. For more daily dose crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.